Hello and welcome everybody to According to Andrew number 114, Gresham's Law, a feature, not a bug. For those of you who are unfamiliar with Gresham's Law, the basic idea of it is bad money drives out good money, and I actually think this is a good thing because there's a lot of warring um, things within currency, and it's trying to do two things at once, and if it's good at one, it's bad at the other. And so I want to get into that. I've talked about this, I think, a little bit on a different podcast of mine. I will link that in the upper corner. um, I don't remember what number it is, but anyway, let's get into it, shall we? Um, So the actual quote from Gresham is, when a government overvalues one type of money and undervalues another, the undervalued money will leave the country or disappear from circulation into hordes, while the overvalued money will flood into circulation. This is commonly stated as bad money drives out good. And then before we get into more of that, I would like to explain the five traditional roles in which money is supposed to be used. So it's supposed to be used as a medium of exchange, a unit of expression, and an object of commerce, i.e., exchangeable good, tool of economic calculation, and an intrinsic store of value. And I think 1 in 5 is where uh, money kind of runs into an issue, because to be a good medium of exchange, you have to be a bad store of value, and to be a good store of value, you have to be a bad medium of exchange. And so this is kind of the war that money has always had. And so I think Gresham's law actually offers us an insight into, well, maybe you're supposed to have two different monies, one that does one and one that does the other, and you can exchange back and forth between these two monies, depending on whether or not you want to preserve the value of your money. And I think that has value over time, and there's various things to be concerned about with that. But let's get into it. Uh, Gresham's law states that bad money drives out good, or in other words, if a piece of paper is valued more than the same as a gold coin, people will hoard the coin and exchange the paper. I think this is a feature, not a bug. To me, a currency is as a medium of exchange and a store of value are competing goals. If you have a bifurcated currency such as gold and fiat, the gold can be a store of value and the fiat can be a medium of exchange. The medium of exchange will get diluted more than the store of value, but as long as both hold their properties of store of value and medium of exchange, just in different proportions. So uh, the money has to hold some, the medium of exchange token has to hold some store of value, and the uh, store of value uh, token or money has to have some properties of medium of exchange, or they can't function as money. So, currency is kind of like a sliding scale between a medium of exchange and a store of value. And if you slide it more towards a store of value thing, yeah, it can still be exchanged and stuff like that. And in extreme circumstances, you might do that, especially if you want to buy a big asset. So a good example of that would be maybe you have, let's say, 4 bars of gold and you want to buy a house. That might be a time where you want to take those bars of gold and use them as a medium of exchange in this particular transaction. Um, they are complementary and not adversarial. Um, in this vein, I think cryptos are another store of value option on top of gold and silver. I think one of the reasons gold and silver have lost their luster is the propensity for those markets to be manipulated with paper, thus keeping their true price suppressed. This is something I wrote for a different letter type thing, so maybe it's not all going to make sense, but I think it'll all come together in the end. This is encourage investors uh, by wanting to use the paper versions and uh, therefore abstract versions. Sorry. Uh, this is encouraged by investors wanting to use the paper versions and therefore abstract versions of them to increase the utility as a medium of exchange. So basically, gold and silver have kind of lost their use as value um, stores of value because they're so hard and annoying to use as medium of exchanges. So their ability to be used as a medium of exchange is diminished to the point that they're not good stores of value anymore. And uh, people would rather have a paper version of the certificate of gold and silver and stuff like that because it's a much easier thing to buy and sell with other people in the chance that you need to use it to purchase something, or you're a lot of times it's just speculators trying to make a buck and stuff like that, and you just get chopped up with fees. But that's beside the point. So anyway, and this is one of the reasons that crypto is a potential something that people are interested in, because they're like, well, okay, I'm already abstracting, and I've basically got a digital version of gold. So like, sure, it's just some lines of code and stuff like that, and it's just like this abstraction that we say has value, but as long as it can remain some sense of store of value type thing, that's valuable to people as a investment vehicle, and we'll get into to why that is in a little bit. Uh, Since investors seem to have no problem with investing into abstractions, crypto plugs a gap in that sense. It can be exchanged digitally, which investors want. Additionally, paper versions of crypto are of marginal utility, as taking possession of these assets is easier than physical gold or silver. You don't have to worry about, yeah, people can steal it and stuff like that, but it's harder to lug around a bar of gold, basically. And then and then I add the caveat. I'm sure eventually there will be some kind of paper system for cryptocurrency. So currently, whatever's built into the code, you can't like J.P. Morgan can't pretend there's more of the coin out there than there is. Yeah, there's inflation bugs and stuff like that have been found in various codes. That's a different problem that does need to get solved. Don't get me wrong, but they can't have like 5% of a certain amount of coin and pretend they have more and issue out shares above and beyond that. Well, they can do that, but because of the nature of being able to take possession and stuff like that a lot easier, it's much easier for them to get bank run in that sense. And until they have a control of it, in a sense, they can't get bank run and have people pull out what on paper is in there, then it's it can't be controlled by centralized institutions, and that's one of the reasons that people suggest taking possession of your own coins and stuff like that. Yes, you run the risk of maybe someone breaking into your house if they know how crypto and stuff like that works, and taking your keys and or your wallet and your keys and all that stuff. But that, like, a lot of that stuff, you run the risk of that regardless of kind of what situation you're in. And there's ways to secure yourself against that stuff. Anyway, it's just kind of another layer of self-responsibility that you kind of need to take, and I get that that's not for everybody. It's the self-reliance thing is a big hill to climb, and there's a lot of rungs on there. You got your food security, you got your monetary security, you got your a lot of aspects to that, and so maybe it's just like, look, I've taken care of. I'm focusing on my food security and some other security type aspects. I don't have the mental bandwidth to deal with this new level of individual sovereignty at this moment, or just I'm not really like, you got to pick your battles. Basically, is what I'm getting to. So, moving on. In a sense, stores of value encourage dragon behavior, gaining wealth. Which dragon behavior, what I mean by that is gaining wealth by simply sitting on it, sitting on your hoards of gold. But I think is a necessary function to allow the economy to function. Investment in new companies is important. Getting into the stock market, investing in new companies is important, but if it is the only option as a place to park your money, then overinvestment is inevitable and decreases the possibility of businesses being successful as anything and everything gets approved. This means that entrepreneurs are flush with cash constantly. Thus, there is no incentive to create useful products for any customer, and poorly run businesses can flourish as much as well-run ones. When the debt system implodes, this might fix itself, but having a place to park your capital while you decide where best to deploy it is a beneficial utility within the economic system. This can take the form of physical cash, but and this is one of the things that people always talk about, like, oh, you should have 5% allocated to gold and stuff like that. But the idea behind that is, it's a preservation of purchasing power over time in general. And so, you have that cash, and your cash, you're going to get diluted. Like, they say, what is it, that since 1913 or whatever, like the dollar's been diluted like 99% or something like that. And so that's a problem. But cash gives you optionality, right? If you don't have any cash, you're basically paying a tax on being able to buy assets at a distressed price. Sometimes that cost isn't worth it. And in times like currently, that price is usually worth it. So anyway, continuing on. So you need a place to park your capital while you're finishing out. But hold up. Doing this will cut down on the amount of entrepreneurs in the system, but the economy will be much better off. And a lot of these entrepreneurs, in air quotes, aren't really entrepreneurs. Like, they're not good at the job. They're malinvested. They should be doing a different job. It requires entrepreneurs to be more innovative and create products for customers. This is something that is lost in the current economic environment. The amount of malinvestment, especially in this area, is staggering, and I think places to park capital outside these ventures will bring the economy back to economic reality. And basically what I'm talking about in there is the 401k situation, where everyone's just been sending money into 401ks and pumping all of these stocks to astronomical levels simply because it's the thing to do. It's the only way. It's one of the only places that you can park your cash and preserve your spending power over the long term. And this has made the stock market inflate, basically hyperinflate. The other place that a lot of cash gets parked, and we've seen prices rise precipitously, is the housing market, though that is mainly fueled by debt. I mean, they're both fueled by debt because that's how inflation happens. But anyway, that wraps up that. And so it's an interesting observation. So basically, Gresham's law: bad money drives out good. But I think it's a better way to maybe state that is exchange money drives out value money, or exchange money drives out store of value money. And so if you're a better store of value, you're going to end up being hoarded, which you should be. And if you're a better medium of exchange, you will be used as medium of exchange, which you should be. And as long as those properties are maintain a semblance of medium of exchange and store of value in their respective proportions, they work together symbiotically. And I thought it was very interesting that Jeff Snyder also had made this observation. I don't remember what podcast it was on, but it was very interesting to kind of hear his perspective on that. Jeff Snyder is basically the guy that I follow to understand the Eurodollar system and kind of understanding what money does and what is money and what's going on with the current economic thing in the Eurodollar sense. So definitely recommend him if you're interested in that kind of thing. The Eurodollar is basically dollars created outside the United States by writing debt certificates via foreign banks. It's ridiculous that is allowed, but it is what it is. So one other thing that I wanted to go into, so if a money is a perfect store of value, and no one wants to exchange it unless they're forced to, and then on the flip side, if you have a money, okay, let's go over this again. If a money is a perfect store of value, then there's no medium of exchange. That means no one would exchange it, and therefore it loses its thing as money. If money is a perfect medium of exchange, then no one wants to hold any of it. So this basically describes the variance between a hyperinflation and a hyperdeflation event. Hyperinflation is people get their money and they spend it immediately because it's not going to hold any value. It's going to deflate a bunch. So hyperinflation ruins trade because no one wants to exchange the money for the goods, as the money is effectively worthless, and it is a supply side restriction. So the people that are supplying the goods, they won't take the money. So that's what the thing that kills the flow of money and the money velocity within the system and the exchange of money. Hyperdeflation is the opposite. Vendors can't sell their wares because the currency keeps appreciating at such a rate that people refuse to part with it unless absolutely necessary, destroying money velocity and creating demand side restrictions. So people basically can't go out and do economic activity because they won't part with their money, right? It's there's no way for commerce and exchange to happen, and therefore has lost its ability to function as a money. I would like to state that there's no situation that I've seen where hyperdeflation has happened. With how things are playing out in the United States, we might be in history with how that happens. We'll see. But typically, because of debt, what happens is the debt will fall precipitously, but eventually it'll hit a level where people who want to take on debt and take on a risk that they can get a better return once the debt levels have shrunk enough, people will start, who were positioned properly, will start taking some of those risks and stuff like that. Maybe there isn't enough people within the society to get things back up and running. That is possible, but at the very least, it should stop itself at a certain point because of the debt situation. I'm not a huge fan of how debt works, but that I think is going to be a stop-loss mechanism for the hyperdeflation situation. Hyperinflation is usually driven by governments and just making the money printer go crazy. So that's not so much a situation. It usually solves a debt problem. So considering that we are in a debt crisis right now, that might be an option. But generally, it seems like America's not going towards the hyperinflation route. So anyway, that's kind of everything I want to talk about. Hopefully you guys found that interesting and now understand Gresham's Law better and how it can be a positive and a boon to an economy. And make you guys realize that maybe fiat and gold or fiat and other assets aren't as adversarial as people maybe make them out to be. So thank you guys for listening. This has been According to Andrew. Please like, share, and subscribe. And leave a comment down below. Don't get a lot of comments, so guess what? If you leave a comment, I'm going to see it. Might even respond depending on what the discussion is about and whether or not I can add to it. So anyway, hopefully you guys have a good day, and thank you guys for listening. Goodbye.